May 17th, 1984, 6:47 a.m., Chicago. Continental Illinois National Bank opens its doors, seventh largest bank in America. Assets worth $40 billion, business as usual, or so it seemed. By 9:15 a.m., lines formed, not customers making deposits, customers withdrawing everything, life savings, business accounts, retirement funds, $6 billion withdrawn in 3 days. By Friday, bank couldn't open, doors locked. Federal agents inside, 81 years of banking history, finished. But here's what nobody understood that morning. This wasn't just another bank failure. This was moment that changed American banking forever. Moment government decided some institutions too important to let die. This created a term you know today, too big to fail. And if you remember 2008, financial crisis, Bear Stearns, Lehman Brothers, AIG, template started here. In Chicago, 1984. This is Continental Illinois. This is a story of how American government guaranteed banks would never face full consequences again. But this is an ancient history. If you have, money in any major bank savings above FDIC limits retirement funds and financial stocks. Pension managed by large institutions. This case established precedent that protects and threatens your money today. Continental's depositors got their money back, all of it, even amounts over insurance limits. Cost? $4.5 billion in taxpayer funds. Pattern repeated 2008, then 2023 with Silicon Valley Bank. Let me show you how government decided your tax dollars would rescue banks, and why that decision still affects your savings today. But first, understand the pattern. This wasn't first bank crisis, won't be last. There's pattern that repeats whenever banks grow too large, and regulators look away. Stage 1. Aggressive growth. Bank chases risky deals. Competitors avoid. Stage 2. Warning signs. Problem loans surface, but hidden in accounting. Stage 3. Loss of confidence. Markets lose trust. Deposits flee. Stage 4. System panic. Fear spreads to healthy banks. Stage 5. Government rescue. Taxpayers bail out to prevent collapse. Savings and loan crisis follow this. Peak, 1989. Long-term capital management followed this. Collapse, 1998. 2008, financial crisis followed this. Lehman, Bear Stearns, AIG, same pattern, different names. Same result, taxpayers pay. In 1982, Continental Illinois entered stage 1. They had 2 years before total collapse. Let me show you how America's seventh largest bank destroyed itself and changed banking forever. To understand what happened, you need to understand what Continental Illinois was and how American banking worked in the early 1980s. If you remember that era, you remember inflation hitting double digits, interest rates at 20%, economy in recession, banks struggling. But Continental Illinois seemed different. Now, while other banks suffered, Continental thrived. The fatal flaw: traditional banking worked simply. Take deposits from locals, lend to local businesses, keep difference, safe and boring. But Continental had a problem. Not enough local deposits. Most large deposits came from corporations who moved money constantly, looking for best rates, unstable deposit base, like building house on sand. Most banks, 60-70% stable deposits from individuals. Continental, only 20%. Other 80%, large corporations who could withdraw instantly if they lost confidence. This made Continental desperately vulnerable. The energy bet. Then came opportunity. Late 1970s, early 1980s. Oil prices surging. Remember? Gas lines, OPEC embargo. Energy companies needed capital. Continental decided, we'll be their bank. They partnered with Penn Square Bank, tiny Oklahoma bank in shopping mall parking lot. The deal worked like this. Penn Square found oil and gas borrowers. Continental bought the loans, billions worth. Without doing own evaluation, why would seventh largest bank trust tiny shopping mall bank? Because Penn Square's founder, Bill Patterson, was charismatic. Because energy sector boomed. Because Continental wanted growth. Roger Anderson, Continental's CEO, made fatal decision. Loan growth at any cost. Let's look at numbers. 1976. Continental is energy loans, $600 million to 1981. Energy loans, $5 billion increase, over 700% in 5 years. That's not growth. That's desperation. What should have happened? Normal bank process for buying loans. Step 1, independent valuation. Step 2, physical inspection of collateral. Step 3, analysis of industry conditions. Step 4, assessment of borrower management. Step 5, credit committee approval, Continental's process. Step 1, Penn Square says loan is good. Step 2, Continental buys it. That's not banking, that's gambling. The stakes. By mid-1982, Continental held $45 billion in assets, employed 10,000 people, served corporations across America. Too large to fail? That's what everyone assumed. The Regulators examined Continental regularly, saw risky loans, wrote warnings, took no action. Why? Because Continental was large, important, connected, and because no one believed major American bank could actually fail. That assumption, that certainty, that complacency, about to cost American taxpayers billions. If you have savings in major bank today, this story explains why FDIC insurance limits exist and why they might not protect you when banks grow too large. First temptation, 1977. January 1977. Roger Anderson's strategy team faces problem. How compete with Bank of America, Chase, Citibank, giants with nationwide branches. Illinois law prohibited Continental from opening branches outside Chicago. Couldn't gather deposits like competitors. Solution, buy loan packages from smaller banks. Let them find borrowers. Continental provides capital. Anderson approves. Meeting ends. This was moment Continental chose volume over quality. Moment bank's fate sealed. The partnership begins spring 1977. Bill Patterson visits Continental with pitch, Oklahoma oil boom starting. Penn Square knows market. Continental provides capital. Continental's credit analysts review proposal, raise concerns. Too risky, too dependent on oil prices. Anderson overrules them. We need growth. This is how we get it. If you worked in banking in late 1970s, you remember cardinal rule, know your borrower. Always. Continental about to break that rule, repeatedly. Escalation? First major loan package, $45 million to 3 Oklahoma oil ventures. Continental's examiner, John Lytle, inspects collateral. Returns with concerning report, values inflated, borrowers overleveraged, unrealistic plans. Recommends rejection. Patterson calls Continental senior management. These are good loans. I stake my reputation. Continental buys, anyway. Within 18 months, 2 of 3 borrowers default. Loss, $28 million, but energy sector still booming. Warning ignored. Stage 1 complete, precedent set. Patterson's word more valuable than Continental's own analysis. The acceleration. Oil prices surge. Iran revolution. Soviet invasion of Afghanistan. 1979, oil hits 40 per barrel. 1980, oil reaches 80 per barrel in today's dollars. Energy loans look brilliant, even risky ones paying off. Continental's purchases accelerate. 1979, $800 million in Penn Square loans. 1980, $1.2 billion purchased. Patterson becomes hero at Continental. John Lytle, the skeptical examiner, reassigned. Too negative. If you remember 2000's housing bubble seeing pattern, when everyone making money, critics silenced. Point of no return, 1981. By 1981, Continental holds $4 billion in energy loans, but quality deteriorating. Patterson's bank growing too fast. Loan officers signing deals in bars, restaurants, parties. Due diligence? Gone. One $30 million loan to drilling company. Continental, can we see financial statements? Patterson, they're good for it, trust me. Continental, we need documentation. Patterson, you want the business or not? Continental buys loan, company bankrupt within year. Collateral, worth 20 cents on dollar. How is this possible? Because Continental addicted to growth. Quarterly earnings showed improvement, stock price rising. Anderson praised. Nobody wanted to admit truth. Growth built on quicksand. Math breakdown number 1. Let's do math on Continental's energy portfolio. Normal bank energy exposure, 10-15% of loans. Continental's exposure, by 1981, 20% of loans. Risk level, double industry standard. Quality comparison, industry average default rate, 3-5%. Penn Square loan default rate, eventual. 48%, gap, 10x, worse than normal. Continental's energy loans, $4 billion expected losses, 4% normal, $160 million actual losses, eventual. $1.92 billion unexpected loss, $1.76 billion. That's not bad luck. That's systematic failure. Numbers don't lie. Penn Square collapses July 5th, 1982, 5 RPM. Penn Square Bank declared insolvent. FDIC seizes control. Examination reveals of $525 million in loans, $400 million were bad. Default rate, 76%. Most sold to Continental Illinois. Continental faces reality. They hold $1 billion in Penn Square loans. Half are worthless. Stock drops 10%, then 15%, then 20%. Anderson holds press conference. Continental financially sound. Penn Square situation unfortunate but contained. Partially true, fundamentally misleading. Because problem wasn't just Penn Square. Continental made its own terrible energy loans. Entire strategy flawed. By late 1982, oil prices falling, drilling rigs shutting down, energy companies going bankrupt. Continental's entire $4 billion energy portfolio deteriorating. If you had money in money market funds in early 1980s, and many professionals did, Your fund likely invested in Continental. Why? Because Continental was 7th largest bank. Investment grade rating, supposedly safe. By late 1982, that safety was illusion. Stage 2, complete. By December 1982, Continental holds $2 billion in problem loans. Capital shrinking, reserves inadequate, everyone hoping. Maybe economy improves, maybe oil prices recover, maybe Continental survives. Hope isn't strategy. For Continental Illinois, time running out. By early 1983, Continental operating like wounded giant, still functioning, but hemorrhaging internally. The wholesale funding trap. Your grandmother's savings account? She doesn't move it. Maybe never. Corporate treasurer's $50 million deposit moved instantly if they sensed trouble. Let's trace the crisis. Step 1, corporation deposits $50 million wires. Step 2, Continental lends for 5-year energy project. Step 3, corporation withdraws next day. Step 4, Continental must find replacement or sell assets at loss. This is liquidity crisis. Works fine until confidence breaks. Then catastrophic. Typical day, 1983. Deposits in, $500 million withdrawals, $400 million net, $100 million positive. But some days, deposits in, $300 million withdrawals, $700 million net, $400 million short. We're fine $400 million borrow from other banks, borrow from Federal Reserve, sell assets at whatever price. By mid-1983, Continental borrowing constantly, every day, just to stay open. Who enabled this? Rating agencies. Still rated Continental investment grade, even as problems obvious. Arthur Andersen audited Continental's books, found reserves adequate. Same Arthur Andersen that missed Enron 20 years later. Regulators examined Continental quarterly, wrote private warnings, no public action. Other banks continued lending, assumed government won't let 7th largest bank fail. This is too big to fail mentality before term existed. The executive mindset. By 1983, Continental's leadership in denial. Andersen gave interviews. Fundamentally sound, short-term difficulties. Energy sector will recover. Translation, we're hoping for miracle. Problem loans grew, $2 billion year-end, then $2.5 billion by March 1984. Management told analysts, reserves adequate. How? Creative accounting. When bank makes loan, sets aside reserves. Suppose $100 million loan, $5 million reserved. What if a loan actually worth $40 million? Reserve should be $60 million. But increasing reserve that much shows huge loss. Tanks stock price. So Continental incrementally increased reserves, slowly, hoping economy improved. This is classic failing bank playbook. Delay, deny, hope. Math breakdown, number 2. Let's do math on funding crisis. Stable deposits. Retail, $9 billion unstable deposits. Corporate, $36 billion ratio, 80% unstable. Industry, healthy standard, 40% unstable, maximum daily. Volatility, normal day outflow, $400 million bad news. Day, $2 billion panic. Day, $6 billion actual, May 1984. Continental had $3 billion in liquid assets. Math, simple. 1 panic day, uses half reserves. 2 panic days, insolvent. 3 panic days, doors close. This is why bank runs work. Math overwhelms any institution. If you had retirement accounts in early 1980s, your money possibly funded this. Continental looked safe, big, established. Appearances deceive in banking. Why size doesn't mean safety. Stage 3, complete. By April 1984, problem loans $2.5 billion capital, $2.3 billion margin, $200 million. One more shock and capital wiped out. That shock coming within weeks. May 9th, 1984. Tokyo. Rumor spreads, Continental Illinois insolvent. U.S. regulators preparing seizure. How did rumor start? Nobody knows. Maybe leaked report, maybe analyst speculation, doesn't matter. In banking, rumor becomes reality fast. Japanese banks, Continental's major foreign depositors, begin withdrawing. $1 billion overnight. May 10th, stock drops 18%, largest decline in bank's history. Andersen holds emergency conference. Rumors baseless, bank sound. Markets don't believe him. Credibility gone. The cascade begins. This is stage 4, where becomes irreversible. May 10th, Thursday. Asian banks withdraw $1 billion. Stock drops 18%. Continental borrows $3.6 billion from Federal Reserve. May 11th, Friday. Domestic corporations withdraw $2 billion Andersen on television. We're fine. Nobody believes him. May 14th, Monday. $6 billion withdrawn in single day. Federal Reserve lends $3.5 billion more, rating agencies downgrade to junk. Too late. Damage done. May 15th, Tuesday. Federal Reserve lending now $8 billion total. Unprecedented. Other Chicago banks. See deposit flight. Treasury Secretary. We have systemic problem. The contagion effect. Within days, depositors questioning all large banks. First Pennsylvania Bank sees outflows. Seattle First National sees withdrawals. Fear spreading beyond Continental. Federal Reserve realizes this isn't isolated. This is systemic panic. Why? Continental held deposits from 2,300 small banks across America. If Continental failed, those banks would lose money. Some might fail. Domino effect. This is too big to fail problem. Banks so interconnected that failure threatens system. The government decision, May 16th. Washington, D.C., Federal Reserve Chairman Paul Volcker, Treasury Secretary Donald Regan, Comptroller Todd Conover meet. Topic: let Continental fail or intervene. Arguments for letting fail. Moral hazard. Free market principle. Management should face consequences. Arguments for intervention. Systemic risk. 2,300 small banks exposed. International confidence at stake decision wasn't about Continental. About system. They decided system too fragile. Continental too connected. Couldn't let fail. Last chance. May 17th, morning. Conover calls Anderson. Find buyer, find investor, find someone to inject capital. Translation: government will help, but you need partner. Anderson calls Bank of America, Citibank, Chase, anyone who might buy. Nobody wants broken bank with $2.5 billion in bad loans. By evening, no options. Except one: government takeover. Personal relevance. If you were watching news May 1984, saw this unfold real time. Headlines every day. Stock market nervous. If you had accounts at Continental or any large bank, you were watching closely. Because nobody was saying publicly, but everyone feared. FDIC only insured up to $100,000. Many corporations, municipalities, pension funds had millions at Continental. Complete failure? They'd lose everything over $100,000. Your town's budget, maybe at Continental. Your pension fund, maybe deposited there. This is why systemic risk matters. Why too big to fail became policy. Let Continental fail, hundreds of thousands lose money, thousands of businesses fail, or rescue Continental, taxpayers bail out failed bank. No good choice, only less bad choice. Stage 4, complete. May 17th, 5:00 p.m. Regulators inform Anderson, tomorrow morning we're announcing rescue. Anderson asks, do I still have job? For now. Translation: you're done, just don't know it yet. Continental had 48 hours left as independent bank. The announcement, May 17th, 1984, 8:30 p.m. Conference call, Federal Reserve, Comptroller, FDIC, Treasury. 9:45 p.m. Decision finalized. The package. FDIC injects $4.5 billion. Federal Reserve provides $8 billion emergency loans. Government takes 80% ownership. All depositors protected, even above insurance limits. All 2,300 correspondent banks made whole. Total commitment, $12.5 billion taxpayer money. Largest bank rescue in American history. May 18th, the rescue. 6:00 a.m. Federal regulators issue statement. Continental Illinois will remain open. All depositors fully protected. U.S. government stands behind institution. Key phrase, too large and too important to fail. First official government statement of too big to fail policy. Markets react, 7 a.m. Asian markets rally, 9:30 a.m. U.S. markets open. Continental stock surges 20%. Not because bank healthy, because government said, we won't let fail. The real damage, federal examiners arrive, hundreds. Task, audit every loan. What they found, problem loans, $4.2 billion, not $2.5 billion management claimed. Actual losses, eventual. $3.5 billion energy loan default rate, 58%. Numbers catastrophic. Human cost Continental employed 10,000 people. Good jobs, stable careers. Within 12 months, 5,000 laid off. One employee, 28 years with Continental, told Chicago Tribune, gave my life to this bank, thought I'd retire here. Now, gone at 53. Real cost of management failures. Not executives, they got severance. Regular workers who did nothing wrong. Shareholder losses. If you owned Continental stock in 1983, January 1983, price 36 per share. May 1984, price 3 per share. Final value, 0.30. Effective $10,000 invested, worth 83. One retiree wrote Wall Street Journal had $150,000 in dividend-paying bank stocks. Continental was safe. People who trusted reasonably that seventh largest bank was safe. They were wrong. Math breakdown number 3. Let's count final damage. Direct losses, bad assets written down, $3.5 billion FDIC capital injection, $4.5 billion Federal Reserve. Emergency loans, $8 billion taxpayer cost. Direct FDIC loss, $1.1 billion after asset sales. Total, $1.5 billion including costs. Market destruction, shareholder equity, $2.8 billion employee pensions, $150 million total economic damage, $4.75 billion perspective, equivalent to $14 billion today, could have built 50 major hospitals, funded FDIC for entire year one bank, $4.75 billion damage. Who paid? Not Roger Anderson. Got $1.2 million severance, not board members. Resigned quietly, not Penn Square executives. Faced no charges. Who paid? Continental's workers, 5,000 lost jobs. Shareholders lost 90% taxpayers, $1.5 billion. This is a pattern you'll see repeatedly. People who cause crises rarely pay fully. People who did nothing wrong bear costs. Continental established template followed in 2008. Stage 5. Complete by June 1984. Continental functionally dead. Government owned, being dismantled, depositors protected, system stabilized, crisis contained. But at cost, $1.5 billion taxpayer money. And precedent that changed American banking forever. Everyone now knew big banks won't be allowed to fail. That guarantee created moral hazard persisting today. Continental Illinois collapse produced no criminal trials, no convictions, no prison sentences. Why? Because reckless isn't criminal. Terrible judgment isn't fraud. Did management lie? Regulators investigated, found they were optimistic, negligently optimistic. But technical fraud? Couldn't prove. Civil consequences. Shareholder lawsuits filed. Settlements reached. Officers, directors insurance. $13 million Arthur Anderson. $5 million. No personal liability for executives. If you lost money in Continental stock, got back cents on dollar, Roger Anderson's fate. Remained CEO through July 1984. Then resigned. Severance, $1.2 million cash, pension intact. No criminal charges, no bankruptcy, comfortable retirement. Died 2007, age 84. His legacy, creating too big to fail. The cleanup, 1994. FDIC's task, recover maximum value. Bad assets sold. Energy loans, $1.8 billion sold for $450 million, 25 cents on dollar. Real estate, $1.1 billion sold for $380 million to commercial. $1.3 billion sold for $720 million to total recovery. One opponent, $55 billion from $4.2 billion loss. $2.65 billion 1994. Bank of America bought remnants for $550 million. Continental Illinois ceased to exist. The too big to fail doctrine. September 1984. Congressional testimony. Comptroller Conover states certain banks so large, so interconnected, that allowing them to fail would threaten entire system. Senator asks, are you saying some banks too big to fail? Conover. Essentially, yes. We have a list of 11 banks we consider systemically important. This created two-tier banking system. Big banks, implicitly guaranteed. Small banks, subject to market forces. Continental started it. If you remember 2008, this list expanded. Over 40 institutions considered systemically important. What changed post-Continental reforms? Enhanced capital requirements, more frequent examinations, restrictions on loan concentrations, liquidity management plans, modest reforms, not fundamental change. Why? Because too big to fail guarantee reduced pressure for serious reform. Personal relevance today. If you have savings in major bank, good news. Deposit safer now. Higher capital requirements, better supervision. FDIC insurance, $250,000. Bad news. Same too big to fail guarantee exists. If major bank fails today, taxpayers likely pay again. If you remember, 2008, Washington Mutual, Wachovia, Citibank, Bank of America, all received government assistance 2023. Silicon Valley Bank, First Republic, FDIC protected all depositors, even over limits, pattern clear. Continental Illinois set precedent continuing today. So what does Continental Illinois teach? Not just about one failed bank, about power, money, systems that should protect ordinary people's savings. Lesson 1, government backing isn't safety. Continental was 7th largest bank, strong ratings, examined regularly, appeared safe. It wasn't. Same pattern repeated, Washington Mutual. 2008, largest bank failure ever, Lehman Brothers. 2008, too big, but failed anyway. Silicon Valley Bank, 2023, collapsed in 48 hours. Size doesn't guarantee stability. What to watch if you have bank accounts. Red flag number 1. Bank growing much faster than peers. Continental 700% in 5 years. Red flag number 2. Heavy concentration in one industry. Continental 20% in energy. Red flag number 3. Unusual borrowing patterns. Continental borrowed from Fed constantly. If you have savings over FDIC limits spread across multiple banks, use CDAR's program, distributes deposits, all insured. Monitor banks' financial reports yearly. Trust earned by transparency, not by size or history. Lesson 2. Regulatory capture threatens everyone. Continental examined every quarter for years. Examiners saw problems, wrote warnings, took no action until too late. Why? Because regulators often know bank executives personally. Hard to shut down bank run by former colleague. Pattern repeats. SEC examined Bernie Madoff multiple times. Found nothing. Rating agencies gave AA to subprime bonds in 2007. All collapsed. Federal Reserve didn't see 2008 housing bubble. This matters if you have retirement accounts. Your 401k holds financial stocks. Bank stocks? Bonds. Your pension certainly does. When regulators fail, your retirement at risk, even if you never heard of failing institution. What changed since Continental? More capital requirements. Regular stress tests. FDIC insurance raised to $250,000, but basic problem remains. Regulators don't want to trigger panic, so they wait. Act only when crisis undeniable. By then, too late. Always. Lesson 3. Too big to fail means taxpayers always pay. Continental established precedent. Government won't let major banks fail completely. Sounds good? Your deposit's safe, system stable, but creates moral hazard. If you know government will rescue you, what's incentive to be careful? Bank executives, take big risks. If succeed, get bonus. Take big risks. If fail, government rescues, keep severance. No real downside for executives, all downside for taxpayers. Continental. Executives walked away comfortable. Taxpayers paid $1.1 billion. 2008. Executives kept millions. Taxpayers paid $700 billion. 2023. SVB executives faced no charges. FDIC protected all depositors. Notice pattern? Comparative pattern table. Let's compare 4 crises. Continental Illinois, 1984. Warnings, 1982. Collapse, May 1984. Gap, 2 years outcome. 1.1B taxpayer loss. Too big to fail. Established savings and loan, 1989. Warnings, 1985. Peak, 99, 1991. Gap, 4 years outcome. 160B taxpayer cost, 2008. Financial crisis, warnings, 2006. Collapse, September 2008. Gap, 2 years. Outcome, 700B TARP, millions of jobs lost. Silicon Valley Bank, 2023. Warnings, 2022. Collapse, March 2023. Gap, under 1 year. Outcome, FDIC protected all depositors. Notice, warning signs appear 1 product 4 years before. Regulators see problems but delay action. Crisis hits suddenly despite years of warnings. Taxpayers bear costs. Timeline changes. Pattern identical. This pattern isn't finished. Right now, 2025, regional banks. Commercial real estate exposure at record highs. $2.9 trillion warning sign. Remote work means office buildings less valuable. Stage 2 evidence. Several regional banks reporting increased loan loss reserves. Stage 3 evidence. Commercial properties refinancing at loss. If pattern holds, and always does, we'll see another regional bank crisis by 2026, 2027. Watch for regional banks announcing commercial real estate charge-offs above 2%, normal, under 1%. Office vacancy rates above 25% in major cities. Wave of loan extensions, banks delaying recognition of losses. Historical precedent, Continental warnings. 1982, collapse 1984, gap 2 years. SVB, warnings 2022, collapse 2023, gap 1 year. Commercial real estate, warnings now, predicted trouble 2026, 2027. Do the math. I'll be watching. New York Community Bancorp, highest CRE exposure. Zions Bancorporation, Valley National Bank. Not predicting failure. Predicting one or more will face serious CRE losses next 2 years. If I'm right, you'll see video when it happens. Because it will happen. Pattern says so. System that enabled Continental hasn't fundamentally changed. Banks chase growth over safety when time's good. Regulators hesitate to act until crisis undeniable. Too big to fail still exists, creating moral hazard. Taxpayers still backstop system when banks miscalculate. Different era, different risks, same structural problems. If you have savings, this affects you. If you pay taxes, this costs you. If you have retirement accounts, this threatens you. Pattern will repeat. Names will change. Dynamic identical. May 17, 1984, 10:15 p.m. Roger Anderson sits in Chicago office. Empty. Staff gone. Building quiet. Phone rings. Federal Reserve. Confirming package finalized. Announcement tomorrow. Anderson realizes this is end, not just of Continental, but of banking era. He built Continental into powerhouse, seventh largest, then watched collapse in 10 days, from $40 billion in assets to government property. How? He chose growth over caution, volume over quality, confidence over evidence, made bet that oil prices would stay high, energy loans would perform, Continental's size guaranteed safety. All three wrong. The question that remains, did Continental failure have to happen? Yes. Because leadership made terrible decisions? Because Penn Square loans were obviously risky? No. Because regulators saw warning signs in 1982, could have forced changes, could have prevented full collapse, but didn't. Because uncomfortable. Because disruptive. Because assumed they'll fix it themselves. They didn't. This is lesson that repeats. Prevention cheaper than rescue. Always. But prevention requires uncomfortable action before crisis obvious. Regulators prefer waiting until undeniable. By then, only option is expensive intervention. What Continental left behind. Continental changed American banking forever. The precedent, government won't let major banks fail completely. That guarantee, stated explicitly May 1984, created two-tier system. Big banks can take bigger risks. Government will intervene if necessary. Small banks, subject to market forces. Fair? No? Reality? Yes. If you're a depositor at major bank, you benefit from this. Your money's safer because government backstop system. But you're also taxpayer funding that backstop. Continental cost, $1.1 billion. Savings and loan, $160 billion. 2008, crisis, $700 billion direct, trillions in economic impact. Price of stability, increasing. What to watch next? I'll be tracking commercial real estate at regional banks. If three major regionals announce CRE charge-offs over 5% by end 2026, we're at stage 3. If 2C deposit flight exceeding 10% in single quarter, we're at stage 4. Pattern predictable, only timing uncertain. Subscribe if you want early warning. Because it will happen. Pattern says so. History says so. Math says so. The legacy. Roger Anderson died 2007. Quiet retirement. No interviews about Continental. His legacy? Creating too big to fail. Not his 40-year career. Not Continental's 1970s growth. Just man who built banks so large, government had no choice but rescue. Triumph or tragedy? Depends on perspective. For depositors, protected 1984. Triumph. For taxpayers funding rescue, tragedy. For future generations, both. Continental Illinois gone. Name disappeared. Building sold. History. But principle lives on. Bigger than ever. Next time major bank fails, and there will be next time. Remember, template started Chicago, May 1984. Continental Illinois. When government official announces too important to fail, they're repeating words first spoken about Continental. When taxpayers fund rescue, following precedent established by Continental. When you ask, why do big banks get away with risky behavior? Answer traces back to Continental. One bank, one failure, one precedent, still shapes American banking 40 years later.